Is SPHD a good monthly paying dividend stock? Or is it overvalued and declining? Today we're going to talk about ETF SPHD. We're going to look under the hood and see what this ETF is all about. I'm also going to give you another alternative dividend paying ETF that might give SPHD a run for its money. Now, let's say I want to open up a lemonade stand and you're a nice person and you decide you want to invest in my lemonade stand business. So you pay me $10 for one share of my lemonade business. But in return, I'm going to pay you a return on my profits that I make from my lemonade stand every single month in the form of a dividend. Doesn't that sound kind of cool? That's essentially what a dividend paying ETF or stock does on a monthly or a quarterly basis. So a dividend is a sum of money that's paid out by a company to its shareholders in the form of dividends from its profits or its reserves. So a few of you awesome people out there in the community have asked me about SPHD, and even though it does pay monthly dividends, is it worth looking into for your ETF portfolio? Now, of course, today's video is for entertainment purposes only. I do not know your financial situation. I'm just some guy on YouTube who sometimes looks like Woody. So giddy up. All right, let's start off with number one of this video. Let's review SPHD, see what it's all about. So SPHD started around $25 per share on average when it first was created. Now it sits at its current level, which is right around, at the recording of this video, $44.22. The nice thing about that is a price appreciation over that period of time of 74.09%. That's not too bad. But the one thing I think that people get so excited about when it comes down to this particular ETF is that this one pays you dividends every single month. You get paid every single month with SPHD. So a lot of people jump into it just for that fact alone. And I'd be lying to you if I didn't say that I did the same. Currently in my Webull account, I own 61 shares of SPHD. Now the trick with this particular ETF is that it aims to track an index. Now this particular index is a high dividend index that keeps volatility low. So from a low volatility perspective, it's avoiding that super mega death roller coaster experience. And it's more like a kiddie roller coaster, or even a nice little train ride through the park. Is that low volatility really a sleeper ETF over the long period of time? Sure, you get paid every single month, but is it worth it? Now, if you look on NASDAQ, you can see that it pays a monthly dividend. Right now, they just announced 11 cents to 12 cents per share, and all the way up to 15 cents per share based on its past trend. This fund has a dividend yield of 3.85%, and that's pretty decent. This means if you want to make $1,000 though, per month in dividends from SPHD, you'd have to invest, get ready for it, $311,688 at the recording of this video. Because doesn't it sound kind of cool to say, I make $1,000 a month off of one ETF? Well, if you want to do that, you got to pony up the dough and put $311,000 in toward that particular ETF. So here we go. Let's look under the hood of SPHD. If you're not familiar how I look at an ETF before I buy into it, I will link that video up above that you can watch after you watch this one that breaks down how to analyze an ETF. Let's start with number one, and that is the expense ratio. So ETFs come with an expense based on you buying into that ETF. This expense ratio for SPHD is 0.30%. That means for every $10,000 invested into SPHD, the charge would be $30. Now, I personally, especially for passive index ETFs like this one, I want to see expense ratios less than 0.45%. Luckily, SPHD is under that at that 0.30%, but that's a little high compared to some of the other ETFs out there and this competitor ETF that I'll explore a little bit later in this video. All right, next up on deck for how to analyze an ETF, number two for SPHD, we need to make sure that when these ETFs are tracking an index, that they're actually tracking their index correctly. You don't want something that says, hey, we follow this index in the S&P 500, but we're like way off in left field and totally screwing this up. You don't want that. You want it in kind of a metric of 1% or less in the tracking difference. Let's take a look at SPHD. Now you can see right here, this doesn't look too bad. What it does is it tracks the S&P 500 low volatility, high dividend index. That's the particular index that this one is tracking. So the good news is that it does track this index within 1%, and this gives that a green light when it comes down to the tracking comparison. Next up, let's look at holdings. Now, SPHD has 50 holdings. That's kind of their methodology. They have 50 holdings at all times, and they rank those 50 holdings in the S&P 500 by the highest dividend yields. But it does rebalance every January and July. So semi-annually, in fact, it's July as of the recording of this video, so they're about to go through a rebalance. So they rebalance this to make sure that they're tracking to those top 50 high dividend paying stocks within the ETF. The challenge with that is, though, that leads us to a little bit of a caution, and that caution is the turnover rate. Because they have to rebalance, there are going to be some stocks that get out of the game and some stocks that get into the game when it comes down to SPHD's methodology. So think about this for a second. I just did a video a couple months ago? I don't remember. It was AT&T. So AT&T has just announced that they're cutting their dividend. So that high percentage that they once had is dropping down. And because of that, they actually had a spot in SPHD, kind of a large position within its holdings. But because they're cutting that dividend yield down, AT&T will likely drop off the list. So they're going to sell some of that and bring in a new high-paying dividend to balance out its ETF portfolio. So if you look on Seeking Alpha, look at this turnover rate for SPHD, 76%. Of course, it does make sense to have a high turnover rate based on what I just talked about, but here's the trick that you need to understand, my friend. So when your ETF has a high turnover rate, it could result in more taxes at the end of the year. So each year your brokerage gives you a statement, and on that statement, you gotta fill out your taxes and all that kind of boring crap at the end of the year. But the problem with that is if you have a high turnover rate, you could be subject to higher capital gains costs. And those higher capital gains equals maybe more taxes. So is SPHD a good one though? Well, like I said, I own 61 shares of SPHD in my Webull brokerage account. You know I like dividends, but I will tell you, I am keeping a close eye on this particular ETF. Here's the reason why. Number one, that turnover rate. I just want to make sure that I'm not paying more taxes than I need to based on that high turnover percentage. Number two, the dividend seems to be going backwards a little bit to me. So check this out for a second. You see a consistent payout of 15 cents per share throughout 2019 and even throughout 2020. But lately, it's been falling to 14 cents per share, and more recently, 12 cents per share. Now, some of this could be a result of the pandemic, and it's kind of catching up to that, but that is also something I'm going to be keeping an eye on. I don't want to continue to see these low or declining dividend payouts every single month. Now, number three, SPHD is that low volatility index. That's a good thing, especially if you don't like a lot of risk. Let's say you're at the theme park. You don't want to get on that super mega death roller coaster that's right up there. It scares the crap out of you. That's kind of what you get into when you invest in high volatile stocks. Hey, here's a good one that's not a stock. Bitcoin, cryptocurrency. Those things go up and down significantly. Just a couple months ago, Bitcoin was going for $50-some thousand, and today it's only going for $30,000. So that's an extreme roller coaster ride. But the low volatility index means that SPHD is trying to pay you those dividends while keeping things a little bit blissful. But outside of volatility, what if we could still keep volatility somewhat sane, but at the same time, get dividends that continue to also give you some growth as well? Enter the competitor. All you gotta do is replace the P with a C. SCHD. This is another Schwab fund. And some people call this the gold standard of dividend growth investing. Now, this fund only pays you dividends every quarter instead of every month. But don't let the payout structure jack you up. Let's go under the hood and compare this one to SPHD, especially if you're looking at making sure that you're doing your research on these two particular ETFs. Number one, the dividend yield of SCHD right now is 2.87% versus SPHD's 3.85%. So right off the bat, you could probably say, well, SPHD is higher, so that one kind of makes more sense. But SCHD has grown their dividend by 13.02% in the last 5 years for the 5-year growth rate versus SPHD's sad little 6.03% growth. And that's something you got to keep in mind. You want your dividends to continue to grow. You want them, it's kind of like getting a raise at your job. You want every single year that dividend growth rate to continue to improve. You don't want it to go backwards and go negative. Now, SCHD, they do follow an index as well, and they are tracking the Dow Jones US Dividend 100 Index. This index measures the stock performance of high dividend yielding US companies with a record of consistently paying dividend. But here's the real kicker, and here's the one thing that I like a lot about SCHD is the expense ratio of only 0.06%. You compare that to SPHD's 0.30%, the answer is kind of obvious which one wins the game there. I also want to talk about holdings. I think holdings are really interesting when you look at SCHD. If you look at the top 10 holdings of SCHD, in my opinion, these are very familiar companies. And some could say that these companies have an opportunity for future growth and performance. You see things like Coca-Cola, you see things like Pepsi, you see things like Pfizer, and you see things like Cisco Systems. They, I think, have future growth potential. And then you look at SPHD, and it's like, okay, these are some sleepers. Of course, you got AT&T, which just recently announced its dividend cut, but it also includes things that, I don't know, what do you guys think about these? Philip Morris Group, they're the ones that make cigarettes, as well as Altria Group. And then you have things like Iron Mountain, you have ExxonMobil, Chevron, some gasoline companies. I don't know, with everything going on in the world, these are definitely those low volatile, just kind of boring type of stocks, in my opinion. I could be wrong, they could grow, they could come out with a new innovation. But right now, I see SCHD as some future potential for growth than SPHD as I look at it right from the surface. But then you look at the market return, and the market return of SCHD, as you can see right here, is a return of 16.30% in the last 5 years, whereas SPHD only has a return of 7.38%. But let's put our money where our mouth is as it comes down to what would happen if you invest money into either one of these. So using this awesome site called portfoliovisualizer.com, you can do a backtest portfolio to compare your growth over a set period of time. So if I invested $10,000 on December 31st, 2012, what would my portfolio look like today if I invested in SPHD or SCHD? That means I'm investing $10,000, not a penny more, but what I am going to do is I'm going to reinvest the dividends that are paid out into the fund. Now you can see right here, the blue line represents SPHD, the red line represents SCHD. For most of the time, they're neck and neck until 2019 when things get a little bit crazy. Look how SCHD starts taking the crown, quite significantly up to the July 2021, where it's up almost $10,000 more than SPHD. That means my $10,000 investment turns into $25,163 with SPHD or $34,440 with SCHD. I got my dividends and I got my growth. Sounds pretty awesome. The best year on SPHD is 22.36% with SCHD at 32.89%. And then if you look at the worst year, because I always think it's good to also look at like its worst performing year when it comes down to analysis, negative 10.35 on SPHD and only a negative 5.56 on SCHD. So SPHD hitting itself a little bit harder over those bear markets. Of course, anybody could be a Monday morning quarterback and say, well, you know, I looked at this and this is what I see. Of course, that's all in the past. What does the future bring? We don't know. So I don't think shares of SPHD are necessarily a bad call, but it's something to keep an eye on. And of course, diversify yourself when it comes down to not only dividend investing, but growth investing in your portfolio. What I do personally is I do 50% of any time that I deposit money into dividend paying ETFs and stocks, and then the other 50% goes to growth. And I actually just did a video on growth ETFs that can really explode your portfolio over the long period of time. You can check out that video in the info card above or down in the description. I'll have a link as well. But either way you swing it, dividend paying stocks and dividend paying ETFs can be a great hedge against inflation, as well as stock market dips and stock market crashes. Check this out. If you compare the S&P 500 versus the S&P 500 with dividends based on your investment of $100,000 in 1990, you can see a great ending point with dividends than without dividends. And yes, that's over $2 million in your portfolio with dividends. Hello, my future millionaires. Subscribe for more. Here's a video on more dividend investing. Here's a video YouTube thinks you're gonna like. Continue to live your sweet life, and we'll see you on the next video.